I went to Bloomberg and I got their ESG report, and this is what they give. They have an ESG score that they give. This is Microsoft. You can see their score over time. It's actually jumped this last year for some reason. Their environmental score, their social score, and their governance score.
That the higher the better?
I think higher is better, but I actually,
I think ESG would be lower the better.
well, I think they're all higher. And then they do the ESG, they have it broken down. You can see a lot of it's just questions that they ask. Here's the next page. Energy efficiency, materials and waste, supply chain, water. The third page. They get into social. If you look at social human rights policy, do you have one? Policy against child labor. I'm hoping most U.S. companies do well on that one. Quality assurance and recall policy, consumer data protection, community spending, equal opportunity policy. So percent of women in senior management, percent of women in middle management. So minorities in the workforce, they don't even report numbers for a lot of these. So that's the kind of thing they're looking at. I don't know if there's, do the auditors go in and audit this to make sure this is good data, or are they just self-reporting? Who knows? The supply chain management, governance, years auditor employed. Usually when you change auditors, that's considered to be an issue, although there have been people saying that you should force a change in auditor because auditors tend to get consulting business and other things that kind of thwart their objectivity. The audit committee, number of independent directors, that can be that one. That's one that I think is actually a pretty good one. If your directors are all management of the firm, that somewhat skews your objectivity. Board composition, board size. We talked about that. Smaller is better. Number of executives. So board meeting attendance percent. Company has executive share owners, director share owners, so that's the kind of thing they're looking for governance. And then here's the last of the governance. Diversity, female executives, number of women on board. So even the governance side has diversity requirements. Age of youngest director, age of oldest director, number of independent directors. So board duration years, I don't know if that is all ones across the top, but how would you use this information? So can you look at these scores and compare them to major competitors and see if they have an issue? I don't know. I grew up before ESG, so I don't really know. I don't know how much these firms can manipulate these numbers to make them look better than they really are. Who knows? USA had a big push to hire more minorities and women, and you really saw a lot more executives. But middle management was really had a lot of women already, not many minorities. So I don't know if USA fills out something like this. What their incentive to do that was probably just they just want to be more diversified. And they certainly put more women on their exec council. Then they've had more women board members. So it's something that firms have been doing for years. How it comes through these scores, I don't know how it looks. So at least go to Bloomberg and do something with it. So put at least a paragraph or two into your paper 3 on ESG, just because it's becoming a big deal. Like I said, in the CFA Research Challenge, it's required. Speaking of that, we can see if we can get a team this year. So find it. So y'all think about it. It's you essentially do the same thing you do in this class. Research challenge in person at one of our participating universities. We've had it at UTSA a couple of times. The 2 winning teams and one from South Texas area go on to compete in sub-regional level. Winners there will move to compete against winners at the American Regional. They've changed that up. The last team, we had a team win 2 years ago. They won Texas and only one team went. So they keep changing the rules. When you get to nationals, it's practically impossible to win at nationals, not because you wouldn't be the best team there, but just because there's just so much randomness to it. You know, two judges see these 10 teams, two judges see these two teams, and they got 10 teams. They got to somehow figure out there's just no way the best team's going to win. But at the Texas level, the winning team really is a very, very good team. It looks incredibly impressive on your resume. If you do it, it's quite a bit of work, especially January, February. If those of you going on a Costa Rican trip, it doesn't really work well if you go into Costa Rica or any other major trip. It is an incredibly impressive thing. It kicks off here. You have to sign up by November, and then it kicks off in December. And they announce the team somewhere in October, November. Unfortunately, they require it to be a team in our region, which is really disadvantaged for us. I wish they'd have every school do the same team. That can be a huge issue when you go to nationals because like our first team to make it did rent the center, just way too easy of a company to do. And so they're going up against firms that are doing these major money center banks. There's just a limit to what you can do. So, but every firm that every team you're competing against in Texas has the same target company. The team that won a couple years ago had a team that was we thought was terrible, and they won the competition even though they had a sell recommendation on it, and that stock has done wonderfully well since their competition. So they had a great report. They won the competition. They were exactly wrong on their recommendation. So if you're interested in this, let me know and I'll forward this to you. They have a detailed flyer they put out there with all the rules. I can help you for up to 10 hours. And what I usually have most teams do is just use the files we used in this class. We've already got a lot of it already built. So you can just kind of double dip on that. Like what we did for Group Project 1, you can do that for the target firm and just put them on in fact, the last team that won, they actually had the chart that you're using to show where they fit on the ranking. You also have a mentor that can help you. So yeah, it is time consuming if you have a really heavy load, and especially if you go to Costa Rica, you'd have to work with your team. Most of the workload is going to be the second half of January and the first half of February. So that's when most of it is. You send in your report, they grade the report, and based on the report, you get invited to the Texas finals, and then from there it goes. So the first part is not a presentation. It's you write a report just like you're doing here. Looks very similar to what you're doing in this class. The second part, they essentially ignore the written part, and then it's all presentation. And then when you go to nationals, it's all presentation. The presentation has to be exactly 10 minutes. You can't go 3 seconds over. Although one of our teams got a few extra seconds because a judge made a mistake of asking the question at the wrong time. It's, oh, you messed up our timing. But no, they sit there and listen to you, and then you go. We've had some of it really is luck. I told the Rent-A-Center team, management is not that important for a firm that's this easy to manage. And one of the questions the judge had was, well, what about management? And he just kicked them completely out because of that. One team that did make it to national, they had a forecast that I thought was ridiculous, and I told them they should take it out, and they left it in. And one of the judges saw that and said an expletive, said a cuss word when he saw it, and they had to explain that. I said, you should have hidden that forecast because that was, so I'll help you as much as I can. They didn't listen to me on that one. They wish they had after that. So if you're interested, let me know. I'll forward this to you. At least think about it. UTSA had done extremely well historically. We're one of the best schools in the state of Texas. We've been there almost as much. There's probably one or two schools that have been there equal or maybe one extra time than us. It's funny, one of the professors from one of the schools that won before our team last time won, she emails me and say, hey, if you need any help or anything, let me know. And I said, well, we've been there X times, so I got some experience. And so, oh, well, that's a lot more than we've been there. So I wasn't trying to show off, but I was just saying, yeah, we've had some experience. So, but thanks for the offer. We also have previous teams that have come back and spoken to teams and given them insights. And I'm sure Bond would be willing to do that. And some of the other teams that won this last time and give you some insights, what you could do. Any of y'all think you might be interested? Maybe a little bit? Yeah. All right. Let me know. if you need help on your resume, that would be great. Even if you don't, it's a great experience. All right. So we're talking about this last part on the accounting and cash flows. So an important concept, we'll definitely use this in paper 5 when you value your firm, is this concept of free cash flow. So free cash flow is what a firm generates that they can do whatever they want to with it. What are those choices? Free cash flow are choices like this. You can pay dividends. You can buy back stock. You can repay debt. You can hold it in short term, waiting for some great opportunity, or you can do CapEx or acquire another firm. So this is the output of free cash flow. How do you measure free cash flow? It depends. There's very many different definitions. I know Catapacum gave you a definition. You can perfectly free to use that definition. You'll see my definition, which is a very simplified one, but I like it. Mine is very similar to what Bloomberg does. It gives you a very similar number. Most of you are going to need free cash flow for paper 5. So you probably learned dividend discount models and those type of models that use dividends. When you use dividends, the value of firm, you're assuming their dividends exactly match their free cash flow. And that's true for almost no companies, or very few, maybe 5% of the companies out there. What they pay in dividends is their free cash flow. So most of your firms, you're going to want to use free cash flow. Some of your firms don't pay dividends at all. I don't think Netflix pays a dividend, do they? Or you have a firm like Apple. Yeah, Apple pays a dividend, but it has nothing to do with the firm. I think Nvidia pays a dividend. It's almost humorous, the dividend that they pay. I think the last time I saw.
Used to.
I mean, you'd think they wouldn't at all now, right? Because, yeah, a 1-cent dividend. This is a $117 stock, and they're paying a 0.4-cent dividend. It's like, why do they even bother? It's just, I don't understand that. There's something bizarre going on with this firm. That makes most, I mean, I don't know if they show the dividend yield. Let's see if they do. It'd be humorous if they do. Dividend yield, it's 0.03%. So I don't know why they do that. You can't value Nvidia on a 3-cent or a 1-cent dividend. They'd be so grossly overpriced, you would never buy the company. You'd have to have a really massive growth rate to get that to work. So free cash flow is what we use for some of your firms. So you have a calculation of free cash flow. What you want to look here is evidence. That's how we're going to do it in paper 4, is what is the evidence of free cash flow? So I have a chart that shows you these 3 things. I have a chart that shows you this one. I haven't done this yet, but we could do it. It's just hard to get cash because firms stick cash in different places on the balance sheet. But if a firm is producing free cash flow, it is paying dividends, buying back stock, repaying debt, and reinvesting and buying other firms. So that's the evidence. If a firm is borrowing money, issuing stock, cutting dividends, cutting back on CapEx, that's evidence they don't have free cash flow, all right? So there's a really good book that I highly recommend right here called Free Shareholder Yield. And they say you can't really calculate free cash flow because it's so different for every firm, but you can tell what firms have free cash flow by seeing if they're doing those 5 things. And that's their whole model. This is a really good book. It's not a very long book, pretty cheap book. I think you can buy it for, less than 20 bucks. Very well written. The book itself is an easy read, and then they have an appendix that's completely unreadable, which I think is their argument that, hey, hire us that manage your money because it looks like it's easy, but it's really not. And so they have an appendix in there. I think they just try to scare us off. I've told students before, I try to get pre-signature in this book. I went to New York the year I retired, went to his company, and with his book, just thinking, oh, he'll be here, he can sign it. And he wasn't in that day, so I had to sit and listen to the stupid spiel. But that was all right. But it's an interesting concept of don't look at free cash flow from the calculation that you've been taught, but look at it from the evidence that they're actually doing it. So the bottom line is, in finance, good companies produce healthy and growing free cash flows. And those free cash flows are either reinvested into the firm and making returns greater than the cost of capital. So this is a big deal you got to talk about. How is the firm reinvesting? What is their CapEx spent on? Or they hold those cash flows until something better comes along, or if there's no good opportunities, they pay it back to the investors. That's what a good firm is. This is what you're looking for a good firm. You're also going to ask how much you're paying for that, but free cash flow is the key. Now, in this semester, we're not doing banks or insurance companies. Banks and insurance companies don't really have free cash flows in this so it gets tougher. That's one of the reasons we're not doing banks and insurance companies. It's really hard to come up with a free cash flow for a bank and insurance company. But for most companies, you can calculate a free cash flow, and it's an important concept. And I'll show you, you'll see the charts when we get into the financial analysis. And here's my blog on free cash flow if you're having trouble sleeping at night. I talk about with Walmart how I come up with their free cash flow. And my free cash flow, it's not all CapEx is the same. So I distinguish between maintenance CapEx and expansionary CapEx. Maintenance CapEx is Walmart spending money maintaining their current stores. Expansionary is them building a new store. To me, that's part of free cash flow. If you build a new store, you've got that cash. You could have returned it to your investors. Instead, you built a new store. You built new capacity. So that's kind of tough to come up with what's the difference between maintenance and expansionary. But you can see my definition here. Dr. Peckham read this, and he had one correction in the last paragraph that I fixed. But otherwise, he didn't say much about it. My guess is he probably would strongly disagree with some of this. But free cash flow is very, very important. It is a concept that we're going to actually, well, I'll put the next page. Actually, it's going to come up when you do one of the valuation models in paper 5. We're going to have you use one of the capital IQ's models, and it's a free cash flow based model because it's an investment bank model. And you'll see how they calculate free cash flow. All right, that's the accounting. So let's start on paper 4. So make sure you take good notes in here. I still see a lot of cell phones in this class that presses the life out of me, but you really need to be paying attention because you're going to have to do paper 4 on this. And I will contradict some of what you've learned in other classes. So you got to make sure you're understanding on this. So this is your financial analysis part of the paper. So we're looking for trends over time. We're trying to figure out the financial health of the firm. There are standard ratios that you can use for most companies, but we're going to be using more generic ones. But I'm going to encourage you, if there's a ratio specific to your company, try to find that particular ratio and use that. You can tell what that ratio is by looking at their annual report and looking through charts to see if there's a particular ratio that they use that you're not seeing in our template. So you want to know how they're using your financial resources. Is management helping the organization, or there needs to be adjustment? At least something to Demotoren's book. It's really interesting him talking about how management should respond versus, whether they have a young growing company or a declining company. Is management focused on the right kind of things? I'm going to jump down. Y'all know this, most of this stuff. This is just introductory stuff. So we're going to look at ratios across time. That's called trend analysis. I'm going to make you compare to your industry, not necessarily to peers, but if you want to compare to a peer, you could certainly add that to your chart. If you have a competitor that's just an obvious one-on-one competitor like Lowe's versus Home Depot, you can certainly redo some of the charts. So you're just comparing the two companies. I just saw an article today that CVS is starting to split out some of its health insurance business, that it just hasn't worked well for them. They're not down as much as Walgreens, but they're down quite a bit this year. So yeah, you compare Walgreens to CVS, both stocks are down, one's down a whole bunch. What are you looking at? What's the trends over time? And theirs is a margin issue. We're going to see what happens to margins. You can compare that to the industry, but you can certainly compare CVS to Walgreens. And then rules of thumb, which we don't have many of them because the rules of thumb are extremely industry specific. That's the reason I'm comparing you against peers, to let the peers define what the rules of thumb are. So is this company's debt level too high or too low? Well, where's 80% of the industry? That's going to tell you if they're in the middle of the bunch or they're way out of scope. There are a couple of rules of thumb I'll give you. When I was at USAA, I got a book from Standard & Poor's that gave rules of thumb for every industry, and the thing was that thick. So it's massive. There's just, every industry has their own rules. If you want to talk about banking or insurance, I can tell you all kinds of ratios. What's the ratio for insurance, life insurance, property casualty insurance, banking? Those are industry. And when you work for an industry, you're going to quickly learn very specific, not just the ratios, but what's a good ratio, what's a bad ratio. That becomes just second nature to you as you work in an industry. I can't tell you that for tech companies or utilities. I just have to look at where the peers are to be able to tell you. Here's our template. We're not going to do this fourth one here. You're going to do that in a later paper, paper 5. So that one comes later. So Beverly's the only one that's done this before in this class, I think. Did y'all do ratio analysis in your accounting classes? So you're gonna have to relearn some of it. Have you done a finance class that does ratio analysis? Corporate finance does, that Catabackham's class. We'll see how different I am than him. So Beverly may have noticed. So we're going to start off with viability. Is the firm going to survive? I'm going to talk about this tomorrow night in the Investment Society for our freshmen and sophomore to try to get them thinking about how they look at firms. But start off, is this a going concern? Is this firm going to survive? JCPenney, will JCPenney still be in business in 10 years from now? Maybe, maybe not. Will Walgreens be in business? I hope Walgreens goes out of business because they so irritate me every time I go by. So will they be in business? Will Walmart be in business 10 years? Yeah, sure. But Walmart's not an issue, but you still got to analyze it. We're going to break that down between liquidity, which is the hardest thing to analyze, and solvency, which is probably the easiest thing to analyze. That's short-term viability. We'll summarize this up by looking at credit ratings, which is a really good way, because that's essentially what credit ratings are doing. They're looking at short-term viability. Is this firm going to be in business 5 years from now, 10 years from now? All right, credit ratings are wonderful because they're really good at what they do. They put a lot of time, and they're going to put a lot more time into this company than you are. If you come out and say, this firm looks great, I don't have any concerns, and they're single B rated, then you messed up somewhere probably. And you need to go back and see where you messed up on. Not all of your firms have credit ratings, so we'll substitute something for credit ratings for those firms. Like Lulu, I don't think anyone's doing Lululemon, but Lululemon doesn't have credit ratings because they don't have any debt. But we can look at them separately with using another ratio. This next thing we're going to look at is once we figure out they're going to be in business, then finance immediately goes to growth. How is this firm growing? We're really focused on revenue growth and profitability. So revenue growth, we can call that activity ratios, turnover, top line growth. Here we're focused on the business. Think of this as the business. How is the business doing? Are they selling more stuff? They're expanding their products or adding more stores. How are they growing? And then you have margin ratios, which is profitability, gross margins, net margins. We're going to look at those definitely. That's what's killing CVS right now, especially their health insurance arm. And we'll summarize these pretty easily by just taking turnover times margin. Pretty simple. Another word for this is return on invested capital. So we'll summarize that up by just looking at return on invested capital, which is essentially what's the return of this firm before you look at their debt versus equity, their financial leverage. Now, when you multiply these, you'll get a line, and you'll have to talk about it, but you really have to go back and see what's causing the shape of this line. The line's going up. Is that because turnover is improving or because margins improving? Or what else is going on? Maybe margins are coming down, but revenues are going up, whatever. So you'll have to break this into the two pieces. This is really the most important part of your assessment right here, especially turnover, I think. Just turnover is how the business itself is doing. Now, you are concerned if management's growing really fast in an area where the margins are terrible and you're essentially destroying value. That's something you have a concern on, but we don't want a firm that's just shrinking. We want them growing their business. And then we'll do our ROE decomposition. Y'all have done that a couple of times, haven't you? So we'll do ROE decomposition. I do it a little bit differently because I think the accountants especially don't break out debt correctly. So we'll change that. Do y'all know any of these ratios? What liquidity ratios do you know?
What ratio?
Current ratio. Beverly, remember what I do with the current ratio? It's been too long, hasn't it? Here's my opinion of the current ratio. So we're not going to use the current ratio. I don't know anyone in finance other than finance and accounting professors that use the current ratio. The current ratio does not tell you, in my opinion, does not tell you anything about liquidity. So we're not going to use the current ratio, right? What about solvency ratios? What ratios do you know there? Debt to equity. What do I think about that ratio? We don't use that anymore. We're going to use debt to EBITDA. Why? Well, we'll talk about that. How about when you buy a house, your bank doesn't do debt to equity on your house? What do? They look at your income. So we don't use debt to equity. All right. We will use asset turnover. We will use gross and net margins. So down there we'll be more like your accounting and finance classes. So I like to teach what people are actually using, not what the textbooks say. So some of y'all you're in your senior year. Get used to this. It irritated me so much several years ago. Every finance major, it was 100% of finance majors, I'd ask them to do a financial analysis, and the first ratio they did was the current ratio. The one no one uses in finance. And they had never heard of these other ones. So there's something going on in the way we're teaching this stuff. So do y'all want to learn the textbook version or what's actually done in practice? At least learn both of them so you're ready. Because I could definitely be wrong on this one. I'll try to prove to you that I'm not. In the ROE decomposition, this is going to be ATO times margins times the tax effect and the financial leverage effect. Which of these do you want driving ROE higher? Are you going to pick a firm because their tax accountants are the best in the business and probably be in jail in a few years? Is that what you're looking for? You want firms that just really load up on the debt? What do you want? This is the key. You want firms that have great turnover and good profitability margins. Costco does what on here? Where does Costco shine? Turnover. By far, they're the best in the business. Where are they really, really weak? Margins. So you're going to find that a lot. Firms that are great on turnover are weak on margins. Is Costco weak on margins because they're bad? No, that's their entire business model. That's their goal, is to kill it on turnover. Walmart is good on turnover, not as good as Costco. They're weak on margins, not as weak as Costco. So that's what you're looking for here. What about Ferrari? Where do they shine? Margins, their turnover, they don't even care. You got a car for $300,000. It could sit there for 2 or 3 years, big deal. But margins are going to be massive. What about Microsoft? Microsoft actually does pretty well on both. Their margin, Walmart's hoping for a 25% gross margin. Microsoft is like 80 something percent. Very different businesses. All right. We can't compare Walmart to Microsoft. We'll compare Walmart to Costco and some other firms, but very, very different businesses. Tesla's really unusual for what? Really great margins compared to other auto manufacturers. And they maintain that, especially with these Chinese companies coming in and being pretty good competitors. So that's what we're going to look at. That's really the key. Are there firms with great tax effects? I'll show you one. none of you are doing this firm, but it's an interesting one. So this firm makes $1 billion and they pay $5 million in tax. That's like a 5% tax rate. Are any of y'all paying 5% tax rate, making $1 billion? So essentially Carnival pays no tax whatsoever. How do they do it? Do they wait until they get out international waters before they open up their gambling sites and all that, right? Why did it do that? You know, it's interesting. You see the same thing with other cruise lines. Cruise lines pay no tax. So the tax effect is essentially one. It has no effect. Tax effect is what percent of your income do you keep after paying tax? For them, it's 100%, almost nothing. Some firms have massive leverage effects. Utilities borrow a lot of money. That's a big adjustment for them. Some firms have almost no financial leverage. A lot of tech companies have no financial leverage. So you'll see a lot of differences. The key for us is how do they compare to the competitors? Now you might say there's no liquidity in here. We've got turnover, we got margin, we got solvency, but there's a huge overlap between turnover and liquidity. So if a firm's inventory turnover is improving, their turnover is going higher, but they're also becoming more liquid. If you can turn your inventory faster, you're more liquid and you have higher turnover. So there's a high over. So essentially the ROE decomposition captures everything: liquidity, solvency, turnover, and margin, all in one analysis, okay? The accountants often either don't break this out or they leave the interest expense under margins. We're going to break interest expense and move it over to financial leverage because that's where it belongs. So that's some of the problems I've seen with accounting classes is this margin includes interest expense. That makes no sense. You want to move that over here, all right? Which means when you talk about ROE, you got to go back and look at all the other pieces to try to see, you know, if ROE is going up, why is it going up? Could be going up because turnover is improving. Could be going up because margins are improving. Could be going up because the firm's taking on a lot of debt. You've got to be able to figure out what's going on with this firm. It's because of a lot of debt. They're not improving the value of the firm. They're just making it more risky. Right? You need this for paper 4, but you also need it for life. So make sure you have a template. If you walk into a new firm and they say, analyze this firm, what are you going to do? You've already got a template for other classes. You can use that, but if you don't, use this one. I mean, if you don't have a template, use this one. It works as a perfectly fine template. All right. And I've got it all set up in Excel. So take that file with you. If your firm has Bloomberg, you can do the entire thing yourself. So I'm giving you something you can use and practice. They will not say, where did you go to school? If you use this template, they'll ask you, where did you go to school? So much, you know, I've known students that this is all they did and they were in really good shape, started off. And I've known a lot of people like graduate students from Harvard that like had no clue what to do. Because what do Harvard do? They do all these case studies. They've never had to go get the data themselves, put it in charts, look at it, assess it. So they're like, what do we do? Here, it tells you from scratch, what do you do, and go do an analysis, all right? So if you haven't done this before, use this template, go with it, take it with you, and it works fine. You do have to be careful with negative numbers. And we'll see that I'm going to be using a CAGR. If you don't know how to do a CAGR, make sure you memorize this. We do it a lot. A CAGR is you take the ending number, divide it by the beginning number, and raise it to 1 over n minus 1. You're essentially looking at a growth rate. You cannot do a CAGR if the first number is negative and the last number is positive. There's just no growth rate there. So you'll see we'll use a lot of CAGRs in here because we're much better with annual numbers than we are with massive 10-year numbers. The other thing you have to be careful of, and you may see this, we're going back 10 years. So 10 years is 2014. It's possible in 2030, when 10 years is going back to COVID, that first year is really unusual. So you don't, and y'all can watch this on your companies. Look at that first year you're coming from, because the CAGR only looks at the first and last number. If this firm normally makes $1 billion, 1.2 billion, 3 billion, But that very first year, they only made $1 million because something wild was happening. You're gonna get a massive, massive CAGR that makes no sense. So you got to go back and look at those numbers. If that's the case, you might do your growth rate instead of doing it from 2014, do it from 2015, and just throw that first year out. You can change the CAGRs pretty easily in the formula. All right. Now let's look at what I want y'all to be using. So we'll go through the notes, but if you look under files and models, you have this financial model that you need to update. It's tied to Capital IQ. We have Capital IQ working really, really well in the FSC. I'm not going to load this one. I think I showed y'all this last time, just to show you again. Let me go through the process just real quickly, what you need to do between now and probably Thursday, but between now and next Tuesday for sure. And I'll have this on the video so you can watch it. I already hit enable content, but Bill Gates likes us to do that twice. Right, step one, someone give me a company. I'll do your company. Target, all right. So what you want to do is bring in column A through I. This is especially important because Cap IQ, every time you change anything, it recalculates, and it's so irritating. So create a new file and paste all that in there. Values. You can paste it as formats too if you want to. So get this file in there. Yeah, Target's not actually a good one to use, but I'll use it anyway. So let's get rid of that. So let's go find Target. So there's Target there. I'm going to put a 2 next to Target because when I sort it, I want that at the top line. All right. Then I got to decide who are Target's competitors. So I'll give you a few choices that you can look at. You might look through them. Target is consumer staples. That's much too broad. Consumer staples distribution and retail. You can see these two definitions are exactly the same. Merchandise retail. Which one would you use? I'm going to go with the second column and see. So I'm going to come down. I'm going to sort it by that second column, which was column A, B, C, D, E, F, I think. You gotta choose your column. Let's go down and find Target. So would you include Walmart as a competitor? Yes. Costco? Yes. Kroger? Yes. Dollar General? Yes. Can you include all of them? Haven't even heard of that last one. That gives me 27 companies. Now the advantage Alejandra has is what she could do is, since this is set up for Walmart, she has a bit of an advantage. She could just change Walmart to 1 and Target to 2 and resort. Because more than likely the competitors I set up for Walmart are the same competitor for Target. So it gives her a huge advantage. But for everybody else, that's why I probably should have used a different company. But should we include Amazon? Broadline retail. It's debatable. I like to keep, and then what about Dillard's? Macy's, Nordstrom's, Kohl's. So I included more than just in that. So sometimes you have to look around. All right, y'all give me another industry. Target was a good start one, but it's too easy because it's already set up. Someone else give me their company. Jake? Ross. All right. Well, Ross might be the same thing. Oh, you gave me Frost. There you go. Well, they're in specialty retail. All right, so you put a 2 there. I've got it sorted by here. Here it just says consumer discretionary distribution and retail, home improvement, apparel, retail. Let's try apparel retail. It's probably gonna be too restricted, but we'll try it. So we'll sort on column H. Go down to Ross. Specialty retail. TJX, obviously, Burlington, yes, that makes sense. What about Barnes and Nobles? Or who is that? Boot Barn, well, that's okay. Foot Locker, Buckle, Victoria's Secret, Guess, Shoe Carnival. Does it bother you that there's shoe stores in there, or is that all right? That's the decision you gotta make. Cato, I don't know who that is. Tilly, I haven't heard of many of these. Stitch, Lands End. I mean, it doesn't look like a bad brand. I mean, bad list. It could certainly work. The one thing that bothers you is you got a lot of shoe stores in here, but why are shoe stores in here? And Nike's not in there. What is Nike under? Sorry. Nike's under textile, apparel, and luxury. No, yeah, what we did column H, right? Footwear. So if you're going to have the Child's Place, which is a footwear place, why aren't you going to have Nike? So you might add footwear in there as well. So you see that the process here is say, okay, here's my company white. Nike's not in there. So you go find Nike and say, oh, I need to add this group in there too. You might even look through some of the categories to see if there's someone in there. Now, how many companies does that give you? That gives you 37 companies. You want at least 25 to 30 if you can get in there. So find the column that best describes what you're looking for. Get more specific the first time, but if you only get 5 or 6 companies, then start broadening it out. Look at what you have and ask about companies that aren't in there. So I would probably include Walgreens in my category with Walmart. And if it's not in there, go find it. Would I include CVS? Well, CVS does a lot of retail, but also has the health insurance. So does it. So Walmart, Walgreens and CVS are in 2 different categories. You have to make those decisions. I would include Amazon. I would include Kohl's in there with Target. But Alejandro might not want to do that. So you have to kind of look and see. But if you look at this particular one, I've got 60 companies. The model does 50. So if I have 60, once you get up to 50, there's no reason to look anymore unless there's some major player out there. What you do after you get your companies, you sort that list of companies by market cap. So if you do 60, it's going to do the top 50 by size. So you have the 50 biggest companies in there, which makes the most sense. All right, give me one more that I can test here. Price Smart. Well, that's going to be the same. I think you can do the exact same thing. Let's find it. I don't know how to do Price Smart. Is that it? Yeah. Yeah, it's already in there. So you just do 2 there, 1 there, resort, you're done. So some of y'all have those speed case. Andrew?
EBCT, Ecovist, ECBT,
DCT?
EBC,
What's the name of the company?
Ecovist.
What?
Ecovist.
Oh, I don't know how do you spell it?
EOEYST.
What?
ECO.
ECO? Okay, let's see if we can do that. Probably gonna be a million. It's not Ecolabs that I learned. Too many. What's the 3rd letter? 4th letter? B as in Victor or B as in victory? Bay Vaca or Bay Burrow? Is that it?
Yes.
Oh man, this is not a firm I know a whole lot about. Okay. Where'd he go? Oh, it's in, okay, find next. There it is. Okay. So ECVT. ECVT. Boy, I hate firms with bad tickers. All right, Andrew, you give me ECVT. Oh, it's because I had that. All right. I would never buy this stock just because I never looked it up. All right, so it's under chemicals, it's under materials, it's under specialty chemicals. So you really have a choice between chemicals or specialty chemicals. All right, let's start with specialty. So we'll put a 2 there. I think we got rid of everything else. We'll put a 2 there, and then we'll sort it by specialty chemicals, which I think we're already sorted by that, right? We're already sorted by H. Let's see how many companies that are in there. Sherwin, there's one of the other companies. Yeah, there's a lot of them. So you can probably make it just specialty chemicals. That's 31. That probably works. Or 30 companies, that probably works. You could look at chemicals and see if more companies should be brought in. One thing you can do, is there a major competitor you're looking for? Make sure it's in your list. If it's not, then go look at the other chemical companies, maybe bring them in. So 31 would be enough. We could sort it. So you don't have Lind in there. Do you want Lind in there? You know, you have to make those kind of decisions. So here's all the chemical companies that are not in your list. Now, if you did just chemicals, you're talking 58 companies. So it's your choice. The real key to me is, are there obvious competitors that aren't in this list? If not, then broaden out to the greater list. You can actually shop one by one. You might say, well, I want specialty chemicals, but there's 3 companies in chemicals I want added to my list, and you just add those 3 in. So it's your choice. Try to get at least, you know, try to get 25 or so. These say commodity chemicals, fertilizers. So you have, so the other thing, Andrew, you can do is you've got all the chemicals together, but you also have these details. So you might say, well, I'll include commodity chemicals, but not fertilizers and agriculture, you know, that kind of thing. So you can really just shop around. Once you get these set up, then you just highlight the whole thing and you sort it by column D first, largest to smallest, and then very last column, largest to smallest. And this is something I know many are going to get, so hopefully everybody's listening right now. You're going to copy it back, but you're not going to copy back the entire thing. You're only going to copy it through column D. All right. You bring that into the other file and copy that in one. You copy that in, and you notice once you copy it in, it updates all that other stuff because it's using the VLOOKUP. Everybody catch that? You bring in, the reason I'm saying bring this into another file through market cap through column I is so you don't have capital IQ recalculating every time you do something, because every time you resort and do all that, like if you want to look, what if I do this combination or this combination? Every time you resort, capital IQ is going to take 5-10 minutes to recalculate. It's going to be irritating. So do it in another machine, but then only bring back the first few columns through D, and then the VLOOKUP will update everything for you. You want me to do one more? Y'all got it? One more, Quincy?
Since we're doing it like a specific company, not necessarily, our group is so wide and well, we took personal beverages, and we got beverages and
Yeah, on this paper, it doesn't have to be the same group of companies that we did in Project One.
so I could be like 0.5%.
Yeah. Yeah, you can get more specific. Now, you don't need to be perfectly so certainly Amazon and Walmart are very different companies. But when it comes to the ratios, they're similar enough that we can look at the ratios. I certainly want to look at Amazon's margins versus Walmart. So don't get overly specific. So you're actually better with more than fewer. So if you're not sure, y'all are doing apparel, right? What are y'all doing? Oh, okay. I would expand pretty broad here. Yeah. Um, it's about as broad as you can get on this category. I wouldn't do General Mills versus Walmart, but you certainly want to do General Mills versus Hershey's versus, yeah, you want a pretty broad group. Anybody else want me to do one, or y'all got it? Okay, Netflix. Finally a ticker I know. So they've got communication services too broad, entertainment probably too broad, media and entertainment, movies and entertainment. So I almost wanted to start with the most narrow definition first, just to see how many firms there are. There's probably not going to be enough. So I'll do column H again. Oh, I didn't put a 2 next to Netflix. So, oh, I just messed that up. So they're the biggest. And then you go down. That's not bad. There's 26. Who else would you want to be in that list? Obviously Disney, Spotify, Live Nation Entertainment. You got some really weird companies in there, but it would work. Is there anyone that's not on this list that you would think should be on this list? But you got Disney in there. You have Warner Brothers, you have Paramount in there. Y'all see Paramount? Yeah, look where Paramount is. They're on the real estate. That may not be the same Paramount though. Yeah, I'm not so sure. But anyway, search and just see if all the firms you think should be in there. But he has a good enough list with 27, 26 companies. And then next thing you do, so you got your list, you got your twos, you highlight it. And here you sort by column D first, because you want that 2 to be at the very, very top. Then sort by column I, because we want the largest companies. So doing both largest to smallest. So D, so the 2 comes on the top, and then all the ones. And then a column I, so the largest companies are on the top, except for your company. Your company will be first, and then the next company is going to be the largest one next. Say okay, and then which columns do I copy? A through D. And then magically everything's updated. I'm not doing this in Cap IQ, but when you do this final post, you want to be in capital IQ. And when you do it, it's going to start calculating. It's going to take it quite a while because it has to update all of this data. And there's massive amounts of data for all of your competitors. There's massive amounts of data. This spreadsheet won't work because I'm not in capital IQ, but just make sure when you set it up, go take a break because it's going to take it a while. All right, so you got your data in, you got your company. Let me shut this down and bring up the company again. Okay, now once you got the company, you go to tickers. You change the name of your company there. And then this clear empty cells, you have to hit that macro and let it run. If it doesn't run, email it to me and I'll work it. I don't know if you tried on the Mac, it may not work. The reason I have to do that, I cannot figure out how to do medians and 10 percentile, 90 percentile. The way I set it up is if there's no data, I tell it to give it a blank cell, but Excel refuses to look at that as a blank cell. It interprets it as a 0. And so what I've had to do is go through and take all those blank cells that are really blank cells and just make them blank cells. So that's what this macro does, all right? Y'all want to guess how I wrote this macro? Any guesses? So AI, yeah, I had AI write it because I couldn't remember how to flip back to that one spot. So yeah, AI wrote this entire macro. You can even look at it. Oh, they don't have the developer tab up here, so you have to add that up. I don't, yeah. But yeah, if you look at the macro, it does that. You just click that. You won't see it in this one when you bring up the one with the capital IQ. You'll see a bunch. What I did is I said, if it's a blank cell, give me 5,000, and then it goes through and finds all the 5,000s and deletes those. Otherwise, your charts will be really messed up, especially on the 0.10%. You'll get some really messed up. All right. So on the tickers page, that's the two things you got to do. Your firm's going to be on top, all the competitors. It goes all the way down the list, but the rest of the spreadsheet only does 50 companies. So it's just going to ignore those after those first 50. Print page 1 is all your company. So this is all just your companies. There's no comparisons. It goes back 10 years. Here's the CAGR formula. So here's the CAGR formula. So if you want to use a different year, we're taking C4, which is 2023, over L9. That's 10 years. Why in the world are we raising it to 1/9? So when you do a CAGR, it's not how many years you have, it's how many growth periods you have. So you grow from year 1 to 2, that's 1 growth period, 2 to 3, that's 2. So 10 years, you do a 1/9. So what if you want to do this to 2015? You change the L, JK. Oh, I gotta think backwards. How'd I go backwards? Oh man, if I hate hitting escape, thanks Zoom for doing that for me. So K, you want to go back? K is what I said. Yeah, so just stuck with K. So instead of L, you do K. Instead of 9, you do what? You do 8. You have to change it in 2 places. The first one just saying if you get an error, give me an NMF, not meaningful figure. So you change it in both places. Now you got to CAGR back to 2013 or 15. If you do that, just put that in there. Or if you only do it on one line, then somehow note it that you know that. But if you want to do them all back to 2015, you can just copy them down. And those are all now back to 2015. You can do your other growth rates kind of off to the side if you want to. 5-year, 10-year, 3. A lot of people like to say, where are they versus pre-COVID? Walmart's done pretty well since COVID. COVID certainly helped them, but they're back even higher than they were with the COVID help that they got. All right. We're going to look through all of these ratios. You'll be using this into your paper. The second page is your graphs. All right. You notice this page I have charts edit for Walmart, that you just want to delete that page. But what you want to do is create a page for yourself. So if I were Hiram, I would say charts for Netflix. Because what you want to do is rather than add any of the charts on this page here, you want to, as you work with them, copy them over and edit your charts here. That way, if you mess something up, you have the original chart. Okay. So what might you do here? Well, first thing you're going to do is you're going to, well, you may change the margins. So I can go back to 20,000. I don't have to go quite so, get rid of some of the white space. I could even do 25. Up 25 was a little much. If you mess it up, you can always hit reset. If you don't like this range, that doesn't look too good. I could do 20 to 35. And do this by 5. So just edit it around. That was a little much. And then what you want is your title is going to have 2 lines. The second line is what's in the chart, cash from operations. And you can say strong recovery, whatever, since 2021, whatever. You may have to change the font some to get it to fit. But you're going to change your titles. My theory is the same as Keith Phillips, our economist. Your title should say what the chart is telling you, why the chart's there. If you don't have enough room in the chart title to get it all in there, you can add a text box that points something out. So essentially, COVID helped them. Great help on COVID. Then it went back to normal. But since COVID, they've come back strong. They've done really, really well. Right. So you just each chart as you go. What I'd really recommend, let me show you the next place we're going. So y'all see where we're going next class. You're going to want to get as far as you can by next Tuesday at the latest. So there's a Word document called Walmart Example Answer. You're going to feel like you're plagiarizing, but that's okay. This is going to be your paper 4. You're essentially going to take this paper and edit it for your company. So the first thing I would do if I were you is go in and take each of these charts and delete them. And then bring the chart, not the one that you're editing, but the one you're not editing, bring that chart in. And I would paste it as a bitmap. As a bitmap is a picture. You can exactly, if you paste it as anything else, especially Microsoft Excel chart, it messes up your fonts, it messes up your legend, it messes up everything. So do it as a bitmap. So do that with all your charts, get them in there. And then you can write up what you need to write up. And then when you finish the write-up, then you can go back knowing what you've written, and you can copy them to this page and start editing your titles. So do your titles last, once you know what you're going to say. Everybody get the process there? All right. So just go through. You'll probably use almost all of these charts with a few exceptions. When you get down to charts 9, I've given you several choices: revenue per square foot, revenue per employee, revenue per PP&E, revenue per store. You're going to pick one of those and take the A, B, C, D out and just call it chart 9. So you'll pick one of those and go with it. The other thing you're going to do is there's going to be places where the 10th percentile really messes things up. So you might just delete it out of it. It works pretty well actually for Walmart. But like here on chart 5, I would definitely take that out. Definitely take that one out. Times interest earned. So there's several of them you'll take out the 90%. For Costco, I don't take out the 90th% because Costco on asset turnover, they're above the 90th percentile. So I can say, wow, they're one of the best in the business. For Walmart, you can see on margin, net margin, they're down near the bottom. So I'd probably do that 0.1% in there just to show how low they are. Costco's even lower. So sometimes you'll leave it in, sometimes you'll take it out. Just depends on what story you want to tell. I usually take the 0.10% out if there's a lot of negative numbers that really skewing the chart down. Remember, I think I showed y'all last time, if there's just one number that's a problem, like 2020 because of COVID, you can just go to, there's a page here called data for graph building. You can just go find that number, delete it, and it comes off the graph. Because if you don't do that, I don't know what chart that was. Let me go see if I can find it. ATO times chart 13, they're numbered, so you can find them. Chart 13. I put that in there. It wasn't that bad, but I put that in there. Just skews the graph. So I take that 1 point out. So you can do some editing here. Some of you are going to have a chart that's like this, and there's one massive V because it's like negative 80% or something. I mean, can you imagine if you graphed cruise lines or airlines in 2020? It's just your chart's not gonna even show up. All right, so there's some editing you're gonna do. What I'm gonna do is I'm going to go through the notes. So we might go through the notes on Thursday. I should have set y'all up better for this, but go through the notes on Thursday. And then next Tuesday, I'm going to go through the ratios and through the Walmart example. And I want you to have your firm up so that if something doesn't make sense, you can ask me and we can look at your company. You could even put it out there on Zoom, share it on Zoom, so you maybe can get on Zoom. Say, wow, my chart 14 just doesn't look right at all. What's going on? We can bring it up and walk through some of the disasters that are going on for some of your companies. It's going to be that difficult. All right. So next few classes, the next class, we'll go through probably liquidity and solvency, maybe get through a little bit on turnover, and then I'll go back and do liquidity for Walmart, going through the example with you having your firm up and loaded. Next Tuesday would be really ideal if you had all your charts in the Walmart example. You don't have to do the editing yet, but your charts in there. All right, I'll let you out a little early so y'all can start getting work on it. We're getting ready for paper 4, which is a much more straightforward paper, a review of financial analysis. So finance analysis is just one of those core things that finance majors can do. Someone hands you a company and say, analyze this company. You should know exactly what to do. Shouldn't be any doubts. It's one of those things that we just do like discounting cash flows. It's really straightforward. So we're breaking it into these categories. We're going to look at the short term, make sure they're a viable business, look at the long term, see if they're growing, and then bring it all together, return on equity. We're going to break the short term into liquidity and solvency, the long term, and the turnover and margin. I'm going to be frequently looking at companies, examples. I've got several already loaded because I've done several of these for my graduate school students. And so I can use their examples to show you some different things going on in each one of these ratios. So liquidity has a couple aspects to it, but the one we're really focused on is on the cash conversion cycle. You may have heard that before, but the cash conversion cycle, essentially what we're asking is that entire value chain from the time we buy the raw materials, we produce the product, we put it in the inventory, we market it, people buy it on credit and they pay us back. That entire cycle is what we're looking at. That's the cash conversion cycle. We want that cycle to be as short as absolutely possible. We want to go from being out of cash to being in the cash. There's some firms that cycle is actually negative. They get paid before they pay their vendors. So that's the Walmarts, the Costco's, the Dell Computers, where they actually have a negative cash conversion cycle. Walmart gets money from its customers before it pays its vendors. It's like the most wonderful thing you can do. So they buy stuff, they buy inventory on credit, they sell it to you for cash or on a credit card, and they get paid from credit cards, and then they pay those vendors later. It's a wonderful model, incredibly good. Most firms, their cash conversion cycle is positive in several days. And that's what we're looking at. Your goal is to understand the cash conversion cycle for your firm, and is it changing? That's our main focus. The second one we're not going to talk about, but that is what happens if you have an emergency situation, you need cash, can you get your hands on cash? That's an important one, but we're not going to address it. At USAA, we spent a lot of time on that. We had a committee to meet quarterly, and we just list all of our sources of cash. We tested them, make sure we could get the cash as quickly as needed. We're ignoring that, but that can be important for firms that, like a tobacco company that could be sued for hundreds of millions of dollars. It can be important for some firms. So the operating cycle, the cash conversion cycle, how long does it take to get from step A to step Z? Everything's happened, the whole transaction's done. Vendors are often paid before you get money from your customers, so you're out that cash, especially if you buy inventory and that inventory is sitting in a warehouse. You spent money for the inventory, but it's just sitting there. You haven't got any cash for it. So that is extremely important to look at. So this is this concept that hopefully you've seen before, but if not, it's very important to understand, is the net working capital requirement. And the net working capital requirement is, it's taking working capital assets minus working capital liabilities. Working capital assets are not the same as current assets. The big difference is working capital requirement, the net working capital assets, or the working capital assets, are only those short-term assets that are tied to operations. Accounts receivable, inventory, and prepaid expenses. Cash is not part of the net working capital requirement. Cash is the result of that. It's the outflow. It's the result of operations. All right. So when accountants talk about the current ratio, they're including all current assets, including cash. We're not. We're leaving cash out because it's not an operating asset. Same thing on liabilities. Working capital liabilities are those liabilities directly tied to the operating cycle, which is accounts payable or trade payable, accrued expenses, which are those expenses you owe your employees, but you haven't paid them yet. And probably one of the biggest one is unearned revenue. That's a huge one. Short-term debt is not part of is not a working capital liability. Short-term debt is the result. So if your working capital requirement is a source of cash, then that produces cash. If your working capital requirement is a use of cash, you got to borrow short-term to fill that gap. So cash and short-term debt are not part of this. So y'all know what all these things are. Accounts receivable. But let me show you one that I think is really, really interesting. In fact, Hiram's is your company. If I can get into it, we'll see if they'll let me get into it. Boy, they've changed their site so much. It's really horrible. All right, here's their balance sheet. Here's their assets. Here's their current assets. So how many of y'all owe Netflix money? You owe them money. No, but I mean, as a receivable, that they provided you services for 30 days and you pay them at the end. When do you pay Netflix? Beginning of the month or end of the month? Beginning of the month. Like when do you pay your apartment complex? They say, hey, stay for 30 days. At the end of the month, you can pay us. They don't do that. So does Netflix have accounts receivable? They shouldn't. But then Hiram looks at the financials and they got $2 billion in accounts receivable. What in the world is that? All right, so you're going to get some curiosities on there. I went through the annual report, and they have something where they provide certain production or something. They have people that are like selling stuff for Netflix and collecting stuff. I know it's really bizarre the way it's written. Maybe I can find the actual quote here. So Hiram will have to figure this out. It didn't make sense to me, but trade receivables consist primarily amounts related to members and payment partners that collect membership fees on behalf of the company. Did y'all know that was going on? $2 billion worth. The company evaluates the need for allowance for credit losses. They even have a setup of credit losses. Company's allowance for credit losses or was not material. So they have accounts receivable. Does Walmart have accounts receivable? And what is it? So Walmart does, but it's really small. Most of us don't own Walmart. My guess is they're waiting for the banks to pay them on their credit cards. That could be it. Because credit cards, Bank of America, they're not going to reimburse Walmart every single second of the day, although it's probably getting close. They probably do it almost every day. So, but why would Walmart have receivables? So you have to look at these accounts and get some understanding of the operations. That gets back to that value chain management. How are they managing these processes? Inventory. Does Netflix have inventory? You see any inventory there? There's not. But could they? Could they show up? What are you going to do with the program they spent $1 billion on that's 80% filmed at the end of the year? Where are they going to show that? Are they going to show that as an asset, or is that going to be entirely expense?
Would it be like, for example, inventories? There was a time where they were doing the CD thing.
Yeah, that could possibly
Would it
be one.
like back in that time.
Yeah, I think they still do a couple of those. Maybe they may have completely shut it down here recently.
Videos, like games.
But if you see your firm has something, you're like, what is that? Go check it out. And this is really true when you start a job. This is what I did at UTSA is like, I don't know what that number is. It's like, I'm not resting until I figure out that number. You want to do, that's how you become a financial analyst is, that doesn't make sense to me. What prepaid assets do they have? It's pretty small, so maybe you could ignore it. They have a lot of cash. That's good. That's fine. But receivables, why does a firm with $48 billion in assets, but no receivables have $2 billion in receivables? That's a pretty big number. It's 5% over 5, 8-9% of their assets. It's a big number, but what is it? So you go to the annual report. How do you do it? You look in the annual report and see where it is in the annual report. Then you do a search on that word. So you go to the balance sheet, you find it. Then you do a search on that and they'll explain what it is. And then you get gobbledygook like this. It's like, what does that mean? To members and payment partners. Who are they? I thought we were members, right? If you join it for, do they call you a member if you have a Netflix account? So what members owe them money? That doesn't make sense. So it gets intriguing how these businesses are run. But then back to them on a new program, a program they spent $1 billion on. It's 80% done, but it's not ready yet. Netflix is weirdly strange about this. It's just incredibly strange how strange they are. They capitalize that, but where's the capitalized cost go? The cash flow statement, it should go under investing. Should be part of CapEx, but it's not. They put it under cash from operations. Why did they do that? It's a big number. So, I mean, it's massive. And look, especially in prior years, it's pretty massive. COVID messed it up because actors couldn't do anything because they get sick or whatever. So COVID messed it up, but it's pretty amazing. Netflix is doing some stuff that I'm a CPA, but what they're doing makes no sense to me, the way they set it up. So for several years, their net income was really high and their cash from operations was really negative. That makes you go, okay, that's a red flag. What's going on with this firm? So this is one of the reasons, or one of the main reasons I don't like case classes, because cases clean up all that stuff, and every firm is complicated. Every firm has a mess that you got to figure out. I figured that out at USA. There was accounts like, what in the world is a deferred premium? I don't know what that is. I had to go talk to the actuaries, and they were talking another language. I just had to beg them to dumb it down for me. But every firm is complicated. There's not a firm out there that doesn't have some type of really incredible complexity to it. I don't want that to frustrate you. I just want you to understand that's where they get paid so much money in analyzing these firms, is you figure those things out to the nth degree and make sure you understand what's going on. So that's a receivable, inventory, prepaid expenses. If it's a small number, you can probably ignore it, but it's a big number, you may want to ask, what is that? What are they doing? Now if you live in an apartment, your prepaid expenses, you pay your apartment rent in advance, that's a prepaid. But other firms have prepaid expenses. What are those prepaid expenses? One thing to remember is one firm's prepaid expense is probably another firm's unearned revenue. So what industry has a massive unearned revenue? What's their unearned revenue? Somewhere in there, but when you buy a ticket from United Airlines, you don't fly for 6 months. That's an unearned revenue. Is that a bad thing or a good thing? If you're an accountant, it's a bad thing. If you're a finance major, it's a wonderful thing. So if you buy a ticket from United Airlines, let's say you buy a $1,000 ticket, you're going to fly in February. What interest rate does United pay you on that? They pay you 6%, 7%, 0%. How much would you borrow at 0%? A few trillion, maybe?
Everything.
Yeah, everything you can get. So when you buy an air ticket from United Airlines, you're loaning them money interest-free. Does that sound like a bad thing or a good thing? Sounds like a wonderful thing. The accountants say it's a bad thing because it's a current liability. All right. They say it's bad because your current liabilities are larger than current assets. You're illiquid. What does it sound like when someone gives you $1,000 6 months in advance? Does that sound illiquid or liquid to you? Sounds pretty liquid to me. Your neighbor says, "Hey, I owe you $5,000. Or I need to get you $5,000. I can give it to you today or in 6 months." What do you say? Say, "Oh, I don't want any liabilities." No, give it to me in 6 months. No, give it to me today. I'll take it. If you're not going to charge me interest, I'll take it today. Yeah, I'll do something with it while you're waiting. So you have to change your mindset that these things we don't like, the assets, and these things we love. Now, accounts payable can have an interest rate to it. You think of the 210 net 30, that's possible. But even 210 net 30 is almost a negative 2% interest rate. But generally, they don't charge interest. Accrued expenses don't charge interest. If you don't pay your employees, but every 2 weeks and for 1 week, 1 week after that, then you owe them money, but you don't pay your employees interest for that. And you don't pay interest on unearned revenue. Same thing with the prepaid expense. Would you rather pay your apartment rent at the beginning of the month or at the end of the month? Much rather pay at the end of the month. It's not a good thing. It makes you less liquid. Would you rather have your inventory sitting in a warehouse or sold in your customer's hands? I'd much rather have it sold. Would you rather your customer owe you money or pay you? I'd rather they pay me. So we hate these things. We love these things. So just bear that in mind. You may have to change your thinking. And I'm not arguing that current ratio is a weak ratio, that it works sometimes, it doesn't work sometimes. I'm saying it's a complete useless ratio that should never be used. I completely throw it out. All right. So if y'all find an accounting professor who wants to debate me in public, I'll take them on. More than willing to, even if they make a fool of me, I would do it just to get students engaged. Yeah, I'd probably be rooting for the accounting professor anyway. So, all right. So a positive number is bad. Put a big frowny space next to that. A positive number is bad. That means their operating cycle is using cash. And they're using cash, which means you're out-of-pocket cash that you're not getting paid any interest on at all. A negative number where the working capital assets are less than the working capital liabilities. That means that's a good thing. That's positive. That means your working capital requirement is a source of cash. The higher the positive number, the more undesirable it is. The more negative the number, the more desirable it is. So it's real easy on the chart. Since I got Netflix, well, since we're talking about Netflix, not to pick on Hiram, but he probably likes that I'm picking on. Let's see his company. Let's see if I can find it here. Anybody doing deer here? Do you have a deer? So what I do for your firms is I take net working capital requirement, I divide it by revenue. Reason I divide by revenue for two reasons. First of all, I used to divide it by cash from operations, but that doesn't work because cash operations can be negative, so it messes it up. So I divide by revenue because revenue can't be negative. The other reason I do is revenue grows with the business. Net working capital grows with the business, revenue grows with the business. So you would expect this thing to be fairly stable over time, that their receivables inventory would be about the same percentage as revenues over time. All right, so here's the question Hiram has to ask. Is Netflix becoming more liquid or less liquid? So higher is bad, lower is good. Are they becoming more liquid or less liquid? Less liquid. Is it a source or is it a use? Negative is a source, positive is a use. So is it a source or is it a use?
Source.
It's a source. It's a source. Right? Their receivables inventory are less than their payables. So for them, it's a source becoming less of a source. Why? I think it's because they started doing all this production, and that production is actually going through the working capital some way. That's why I'm not real sure about their accounting, but I think it's that increased production where they're actually, instead of buying other people's shows, they're actually producing their own. I think, I can't prove that. Hiram's got to figure that out. But that's going in that direction. Let's look at another firm. Let's look at Deere. I love Deere. It's a great company. Someone should have picked Deere. Who's doing capital goods in here? So Stephen, anyone on your team doing Deere? Oh, you're doing Deere. Okay, so Kendi, you can look at Deere. Yeah, I love Deere. And your paper 3 is probably pretty fun. It's a really interesting firm. A lot of stuff that they're doing is really quite fascinating. It's a pretty advanced firm, right? And pretty heavy in the AI and the drones and all that. So there's an interesting firm. Are they becoming more liquid or less liquid? Less liquid. And not only that, but they switched from being a blank to being a blank. They used to be a source of liquidity. Now it's a use of liquidity. So why is that? All right. Well, what Kendi's got to figure out is why is that, but I give her some help down here at the bottom of this print, page 1, where it shows, and you can look here and see where did it really shift. And it really started shifting in 2017. So let's look at 2017 versus 18. 17 versus 18, which salute. If you look at 17 versus 18, accounts receivable jumped $1.2 billion. Inventory jumped $2.2 billion. Accounts payable went up 1.5 billion. Which of these really stands out for you? Don't they all? Something really happened in 2018. What was it? Did they buy another firm? That sometimes can be the case. They buy another firm and you pick up their inventory and receivables. But something happened. That's where it switched from a source to use in that 1 year. But it jumped again this year. Where did it jump there? Well, their accounts payable dropped. Then it improved. Why did it improve? Because receivables, and so they're all over the place. So it's hard to say what's going on with this firm. It's all over the place. If we look at Netflix, let's see if we can figure out why Netflix deteriorated. Go to the bottom of print page 1. You see we have the assets and we have the liabilities. What do you notice with Netflix on accounts receivable? Went from 0 to 1.2 billion. Their other current assets went from 0 to 409 million. That's that accounts receivable. I was like, why do I have accounts receivable? So I was wrong, Hiram. It's not to your production, although that may be related to production. So for Hiram to figure this out, he's gonna have to go back to what I was talking about. What's going on with receivables? It's that trade thing I just read to you. So it's strange. What I'm gonna let you get away with in paper 4 is according to your report, blah, 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 blah. I'm not really sure what this means. It needs more research and you can move on. Otherwise, it's going to take you 30 hours to figure it out. Some of these firms are so complicated. But taking a stab at it, try to figure it out. Their accounts payable have grown, but not that materially. Other current liabilities have grown. They've grown some, but the big thing is they went from having no accounts receivable to now having 1.3 billion. What's going on there? It's an interesting number. How do you reduce the working capital requirement? By managing that operating cycle. Speed up the collection of receivables, get a better inventory flow so that your inventories turn faster. So I remember I told you liquidity and turnover have a close relationship. So we'll talk about inventory turnover later when we talk about turnover. But if you improve your inventory turnover, you improve your liquidity because it reduces that inventory on your balance sheet and reduces your net working capital requirement. So how do you handle that? Efficient management. You do something to improve those processes, whatever you can do to improve those activity ratios. There are industries that have certain ratios that tend to stick, so they tend to have that. Obviously, most retail has inventory, huge inventory amounts. But I can't remember if we talked about this or not, but AutoZone is a good example. I don't know if I can show you their data or not. So AutoZone has a massive, massive inventory. Why do they have a massive inventory? Because they want to make sure if you show up, it's going to be in stock. It's incredibly expensive for the firm. But what else do they have? They have a massive, massive accounts payable. Do you notice that their working capital requirement is actually a negative number? How can a firm that says we are going to have inventory on site when you drive up, even if you have an 87 Buick, whatever, we're going to have the hubcap, probably not, have the gas cap for that. I don't know how specialized they get, but they're really good at that, having the part in place when you need it. How did they get away with it? Because AutoZone is so highly respected, they're so trusted, and forgive me if I already talked about this before, but so trusted that their vendors say, you can pay us late. Why would their vendors let you do that? Because AutoZone is such a great company, their vendors can take that accounts receivable, go to a bank and factor it and get their cash today. Because AutoZone is highly trusted. AutoZone manages this. So if you listen to the business breakdown for AutoZone, I mentioned it last night in Investment Society, AutoZone's a perfect example. Why do we love negative working capital requirement? Negative working capital, and AutoZone's a perfect example. They have this heavy, heavy cash requirement of needing inventory, but they manage it by paying their vendors very slowly, and their vendors let them do it because they can factor that receivable. It's an amazingly good model. And you actually hear them, and it's wonderful way he sets it up. Says, it's amazing, AutoZone is so good at having inventory on stock, and yet this firm has negative working capital. And the interviewer goes, wait, how can they have negative working capital? And they both know that's a good thing. The accountant listened to it, is going, oh, that's bad, that's terrible. And then they go, wait, they're saying that's good. And they're all confused. But finance majors are going, no, negative working capital is exactly what we want. That's wonderful. All right. So even a firm that has a working capital problem has figured out how to handle it, how they deal with their vendors. Tremendous business model. Sales growth can also influence it. It's going to impact your receivables, inventories, under revenues. So I met with one CFO once of a small tech company doing extremely well. They had this software, UTSA could use them great because it's a software to help you move your people around the building efficiently. And it was really, really good software. It's like a real estate software. And they were doing great. Their revenues are growing, their receivables are growing. The CFO goes and said, okay, why are our receivables growing so fast? Why aren't we collecting our receivables? So he went and talked and they discovered that their contract said, if you buy our software and there's any problem, any minor problem, you don't have to pay us until we fix that. What was the sales force doing? They're going out and selling new software. No one was going back and fixing the problems. So they had all the software sold, but no one was paying them. And the CFO said, you might like your sales commission, but we're out of business if you don't go back and fix those problems. So massive liquidity problem. And they had to go back and fix it. And the sales reps didn't like that because there's no more commission going back and fixing it, but they couldn't make it any other way. So there's things going on. So now let me find another one. I don't know if I have another one of y'all's. Someone's doing Costco maybe or not.
Casey's.
Huh?
Casey's.
Yeah, I don't have Casey's. I do have Casey's somewhere, actually. I have to go find it. I don't have it in this list. So what do you think about Costco? Positive net working capital or negative net working capital? What would you guess?
They hold a lot of inventory.
They hold inventory.
I would say there's more of a use. If I was just a guess, it'd be like a use.
All right, well, you'd be surprised with, so here it is.
Oh, wow.
So is it a use or a source? Source. Is it getting better or worse? It's kind of just holding its own, not really going up or down. It dropped a bunch in 2020, maybe because they got rid of all their toilet paper inventory. Someone said toilet paper is being rated again. Is that true? Because of the
Sherman
yeah.
Union.
Gosh, we're kind of crazy people. I would have been stocking up on bananas, but but then you have to they don't last very long anyway. So yeah. So it's too late for y'all. You've already taken your accounting classes, but when they tell you a higher current ratio is good, what you can do is go and say one of the most liquid firms in existence is Walmart. And their current ratio is negative. I mean, it's less than 1. Their current assets is 76 million, their current liabilities is 92 billion. And yet this is why I hate the ratio. So I kind of say, yeah, there's some exceptions. Walmart's liquid despite the working capital ratio. Say, no, Walmart is good because of their working capital ratio. They're liquid because their current assets are less than, it's the same. It's not like it doesn't work for a few companies and ignore it. No, the current ratio is actually telling you they're liquid because their current liabilities are greater than current assets, especially once you take cash, short-term debt out, that's what you want. So it's actually the most liquid companies actually look bad on the current ratio. So I don't think the current ratio tells you anything about these firms. For older companies, working capital tends to be a source of cash just because they're not growing as fast. So they just get much better at managing that inventory. Younger companies can have serious problems if they're growing too fast. The working capital can put them out of business. They've got to start working on that equation to figure out what they're going to do because they're just growing so fast. They're piling up on inventory. So that can be a major issue for them. Just-in-time inventory is part of the fix for this, where you want everything to show up just in time. The problem with just-in-time inventory is when you have a strike going on the coast. Now your just-in-time inventory is nothing shows up. COVID destroyed just-in-time inventory. the supply chain things that broke down. We've had some hurricanes, so actually the Japanese earthquake. So many car parts came from Japan, and that Japan earthquake, firms couldn't sell cars because they couldn't get the parts. So if you're just in time, that's wonderful. But if you have those type of hiccups, it can put you in serious trouble. All right, so grocery stores, hopefully they're really, really good at this. They know exactly when things run out. My HEB, every once in a while, they're completely, like, I like cashews and they completely ran out of them for 3 weeks. I'm like, what's the deal with this? It strains me sometimes when just one thing runs out and it's gone forever. I don't know if that's true of all the Walmart, I mean, all the HEBs at the same time, but that's a huge job. If you're going to manage a Walmart, you're going to manage inventory. So you got two problems. You don't want to have 2,000 bags of cashews sitting there, but you don't want to run out, because you run out, you lose sales. So you're going to get that perfect. Did y'all do total quantity ordered and all that stuff in your management classes? Y'all remember that? There's all these models. You imagine AI is getting much better at this. You're figuring out exactly when you should reorder certain things. But again, that can really mess things up in a crisis of some kind. The cash conversion cycle may or may not work for your firm. I put it in the Excel spreadsheet, and we'll talk about it more when we get to turnover. What the cash conversion cycle asks is, how long do your sales stay in receivables? How long do your sales stay in inventories? And how long do your inventory stay in payables? So 3 days for Costco for their sales, that's probably credit card companies paying them. 28 days, that's how long their inventory sits there. But then their vendors, it takes 41 days. So their cash conversion cycle is not minus 9 days. They actually produce cash 9 days. When they start the whole process, they receive cash, and 9 days later, the process is over, and they've actually start off their cash rich the whole way through. What do you notice about the cash conversion cycle over time? It really got good in 2021, probably because of COVID. It's now down to more normal levels where they were. Cash conversion cycle may not work for all of your firms, so don't overly rely on this. It can be a little tricky, but it works for them. We can look at it for Deere and see. Yeah, Deere had something happen in 1 year that's kind of bizarre, and who knows what, but they tend to be, well, they've been all over the place, but 40 days. So they're more than a month it takes them. That's pretty illiquid. And you notice, back to my point, they used to be liquid, now they're illiquid. What did you notice on the cash conversion cycle? Used to be negative, now it's positive. So you see on these turnover ratios, there's a close relationship between turnover and liquidity. They're almost just attached at the hip. Very, very important. So unearned revenue is a wonderful resource. Now, I don't know, I haven't done United Airlines in this model if they have a negative working capital requirement. They may have a negative working capital. That's kind of the best part. United is a horrible, horrible industry. Airlines, heavy capital requirements, thin margins, very cyclical. Everything's horrible, but that's the one thing they've got going for them is the unearned revenue that may help them manage some liquidity. I don't know how they survived 2020. They were really nice about returning airfare for trips. It's kind of nice. We had a New York trip scheduled for the Investment Society, and I'd already paid for all this stuff. And then they canceled, and I was like, I need my money back. They said, Professor, if you pay for it, we'll reimburse you. And then they canceled everything. It's like, oh, wait a minute, I might be get like shafted here, but I got all my money back. So that's, I don't know how they got that money, where they got that money from. They borrowed a lot of money. They're already heavy in debt as it is. How do you fund the working capital requirement? And there's something called a matching concept. I'm not asking y'all to do this in your project, but you do have some concern if a firm has heavy, heavy short-term debt. About the only time you want short-term debt is if your working capital requirement is short-term. It's 9 days, 10 days. You can use, or 30 days. You can use your short-term debt to fund that liquidity of their net working capital requirement. really for any, if your net working capital requirement is a year, you don't want to, you really want to go out the longer term. Wall Street hates short-term debt quite intensely. Short-term debt exposes you first to refunding risk because you're constantly going out to the market to borrow money. If you get a crisis like in 2008, you're going to go out of business. It also exposes you to interest rate risk, like we've seen here. When interest rates shoot up, your cost of debt shoots up dramatically. So Wall Street prefers you issue stock or issue long-term debt, but they're okay with using short-term debt to fund this net working capital requirement if it's a short-term need. All right. So compare that to what accountants say. Current ratio is traditional view. You've already heard me say that the asset test to me is even worse. So take out inventories. These are just not, these are not good ratios. And again, what bothers me is this is usually the first ratio on a finance major will calculate. Because it's so easy to calculate. We love it. It's so easy to calculate, but it tells us nothing. Anybody want to defend current ratio? It won't affect your grade. I'll forget that you said it by the time I grade you. No one wants to defend it? What would your accounting professor say to defend it?
Quick snapshot, company's out.
Yeah, so does it tell you about the company's health? I say doesn't tell you anything about it, but so I don't know. So get the professors, set up a public debate.
Okay.
I agree having a lot of cash is great. Apple has a lot of cash. USA had $200 million in cash, negative $300 million in cash, $300 million in cash. I mean, it's all over the place. Why? Because they put it into investments immediately because it's an insurance company. So their cash balance is pretty unimportant. Apple has a lot of cash, but they put them into like 1 and 2 year securities. So they're not even shown as cash anymore. So that's not even their current assets anymore. So cash, the problem with cash is it's very manipulative. You can put it all kinds of places. You can invest it, you can put it in 2 year bonds or whatever, and so it's a pretty unreliable number. So I don't like it. It does give you a quick answer, but I don't think it tells you anything. So you get a quick snapshot of what. So I don't really like it. So what should you look at for liquidity? We're going to cover a few of these in your paper 4. The first one is trends in cash from operations. That one we are going to do. It's really, really simple. Is cash from operations growing, shrinking, going flat? What is it doing? All right, so pretty simple. For Walmart, I don't have Walmart. For Netflix, you go to their print page 1, cash from operations is lines 12. Their cash from operations is growing 96%. That's the CAGR. Now, what's wrong with the CAGR? It takes the first number and the last number. So Hiram's probably not going to quote this 96%. He's probably going to quote what it's done the last 4 years. Now, why is it negative here? Those are those production costs I was talking about. Producing new films. 2020 shut that down, but they started adding a lot of new shows, and so their cash from operations was negative. So if you have something crazy, you could add an MFF. That means it went from a negative to a positive number. You don't show the CAGR at all. You just talk about the numbers. You can say they went from a negative $100 million in cash from operations. Now they're positive 300 million. So great improvement. Plus the graph is going to help you. The graph is going to show you. So what does that look like? Great improvement from cash from operations. So we're going to talk about that. That's an easy one to talk about. You're going to talk about, obviously, is net working capital a source or a use? I say how it compares to the industry. We're not actually going to do that. You can do that if you'd like to. The only way you can do that, because I don't have this chart for the industry, the only way you can do that would be to redo the Excel spreadsheet for other companies. So I'd be really impressed if someone did that. You could do it pretty quickly in Capital IQ because all you have to do in the spreadsheet, if you want to look at other companies, all you have to do is take this company and put it, you have to do it in the Capital IQ one. You can't do it in this one's got values, but you just copy that company. Whatever you put right here in row 2, that's what your chart 2 is going to be. So if you want to look at 4 or 5 other companies, you can quickly do it, get the graph, and just put it to the side so you can see, is your firm radically different? Or collect the data from the graph. Remember, you have this page data for graph building, you could just go for chart 2 and collect the data for your company and 5 other companies, create your own graph. See how your company compares to the others. All right. I'd be impressed. No one's ever done it before. I'd be really impressed. Right. So their net working capital requirement, you can see it down here. It's been a source, but it's actually coming down the last few, coming less of a source, especially, it's grown 2.2%, but on a firm that's growing 37%. So they're becoming less liquid. As their working capital, you would hope as a source that it's growing at 33%, but it's not. Real critical here, get this in your notes. This CAGR, whether it's good or bad, depends on whether it's a source of use. If their working capital is a use of cash, what kind of CAGR do you want? A high one, a low one, or a negative one? It's a use of cash, what do you want? I'd want a negative CAGR. If it's a source of cash, what do you want? You want a high number. In Netflix, it's a source of cash, but the growth rate's really small and the company growing really fast. So it's becoming less liquid. And you can tell that when you divide it by revenue. That number has come down from 5% down to less than 1%. So they're becoming less liquid. And then trends, working capital. And I also want you to talk some about the driver. I gave you that example. Is there accounts receivable jumping? Is there inventory jumping? What's causing it? Or your inventory declined? Find some cause. And I gave you that one table. Bottom of print page 1. Bottom print page 1 shows you what's going on with all the accounts and net working capital requirement. So for Deere, it's definitely a use now. It used to be a source. We talked about that. So try to figure out what's driving it. For Kendi's case, she's saying something obviously changed in the business in 2018. A big jump in receivable, big jump in inventory, big jump in accounts payable. But the jump in inventory and receivable was much larger than the jump in payable. Why is that? I don't know. One way you can figure this out is you could go back to the 2008 annual report. And you see big jumps like that, there's going to be some explanation in the annual report explaining why they had that jump. Usually when you see a big jump like that, that's hitting several accounts, and look at their revenue. 29 billion to 37 billion, that's usually a merger of some kind. So what I do there is I go here, acquisitions 2018. Acquisition of Speyer. How big of an acquisition was it? They don't tell you. I don't know who Speyer is. Has complete acquisition of the acquisition agreement to purchase them. A privately held manufacturer of sprayers, so PLA, based in Argentina. That doesn't look big enough to me to be the cause. 450 employees. Deere acquisition spree. That might help you. I don't know whether there's 2 bulls there, but acquire King Agro from Spain. They're not only an acquisition spree, they're also overseas a lot for some reason. So can you find that? The other thing you can do, if you think there's an acquisition, is in Bloomberg, you get on the Bloomberg machine and type MA for mergers and acquisitions. You can type in your company and list all the mergers that they've done. And what you're looking for is a big number, because this is a big deal. $12 billion extra revenue. I don't think 450 employees in Argentina are working for a firm with $12 billion in revenue. So that's unlikely to be the answer. But you can go into the MA function in Bloomberg and find that. I recommend you do that, not because of the grade, but you got to get in the habit of what do I do to research this stuff. Become a research, you're almost a forensic finance major. You want to figure out, why is this number changing so much? So for Kendi's case, a bunch of accounts jumped, so it's probably an acquisition. So she can probably just talk about that acquisition. This deterioration in liquidity for Deere is due to the $X billion acquisition of XYZ Corporation in 2018. It caused a big shift in the, whatever, so. The use and structure of debt, we're not going to cover that in this paper. The sources of liquidity, we're not going to cover that. You might have covered that in other classes. The annual report does talk about that. When is their debt due? What's their debt payment schedule? Any potential liquidity shocks, we're not going to cover that. And then we are going to do this last one. So we're going to do these four, three really. Trends in cash from operations, working capital, and trends in free cash flow. Those are the three I'm asking you to cover. And you can see that's the list down here, list that you're going to do. These other things are important, but I just don't want you spending time on them because they're pretty tedious to assess. And actually, some of this stuff is not available anywhere. It's inside information on the firm, so you wouldn't be able to find it. So those are the three you're going to do. All right, let's move to solvency. I'll come back next class. Make sure you have your data loaded. If you're having any trouble, catch me Monday or Tuesday. Really important. If you don't have your data Tuesday at 5 o'clock, come down to the FSC and we'll get your data. It generally takes me 5 minutes to get the data. It's pretty fast. It's not that time consuming. So if you can't get it to work out, come to me and we'll get the data for you. And for some of you, I already have the data because I've built it for other classes. So we already have it, so I can help you with that. Any questions on liquidity? Solvency is much easier to assess. There's two things we're looking at on solvency: their ability to pay the debt and their amount of debt. Do they have a good ability to pay the debt, and do they have too much debt? So the amount of debt, we're going to use debt to EBITDA. We're not going to use debt to equity, but I do have it out there. Look at print page 1. I gave you both of them. Debt to EBITDA and debt to equity. But I was talking to my friends at Victory Capital, and they've been using debt to EBITDA for over a decade. There was a shift about 10, 15 years ago. People just stopped using debt to equity, and they started using debt to EBITDA. And it makes a lot of sense. If you buy a house, they're not going to ask you for your net worth. They're going to ask you for your income. That's just the way we think about debt. How much debt do you have versus your income? Also, if you take a firm like McDonald's, and you look at their debt to equity, what do you notice about their equity? Negative number. How do you do debt to equity when you have a negative number? That's kind of tough. I don't know what I just did. Boy, that's strange. So some firms, Starbucks, I think someone in here is doing Starbucks, yes or not? So yeah, Starbucks, you're going to have some struggles in paper 4 on Starbucks. We'll have to talk about how to handle that. So if you have this, there's other places we're going to use equity, like return on equity. You can't do a return on equity of negative equity. On those, what we'll do is we'll substitute return on invested capital, and then we'll just address the issue of having negative equity. So I don't think many of your companies have negative equity, but it is a problem. It is a definitely issue. In fact, it's so irritating to finance. I'm surprised firms take their net worth to negative because it makes it really hard to analyze the firm. So we use that to EBITDA. So EBITDA. So for Starbucks, that's not a problem because they have positive EBITDA, so you can still do this ratio. Another one we're going to use in the ROE calculation is assets to equity. So again, that's going to be a problem for Starbucks. But assets to equity, that's just our multiplier in the ROE decomposition. That's the only place we can use it. So we're going to focus on debt to EBITDA. Now, what other adjustments do you make? If your firm has heavy capital leases, you would add that in. Anything else that's debt-like, I'm not necessarily bringing those in, but whatever you have is debt-like. One thing you got to be careful of is on the debt to EBITDA, I believe W55. Yeah, I should have, LT, all right, so there's two types of debt to EBITDA. I think I used the second type, but there is total debt to EBITDA and net debt to EBITDA. Sometimes I use total debt because it's not as problematic. Net debt is they take total debt and they subtract cash, which means net debt to EBITDA can be a negative number. And I think I'm using net debt to EBITDA because it is the better number. It's true, Apple has debt, but they also have $150 billion in cash. So it's not really that, and the reason they have debt is because of tax purposes. It's not because they really need the debt. They could do everything in cash. It's just they don't want to pay tax in the United States. So they're keeping stuff overseas, but then they're using debt overseas to pay over there. So yes, so net debt is what I use. So some of your firms, this section is going to get pretty easy. If they don't have any debt, you don't need to show the chart. If the net debt is negative, you don't need to show the chart. So in those cases, you're just going to say this firm doesn't have debt, or if they have debt, it's less than their cash. Obviously, debt is not a problem. So some of y'all get off the hook with really, really easy analysis. The other issue you're going to have is on the second ratio. So I don't know any firms here that have negative debt. Which firm is this? Netflix. Their debt to EBITDA. So this is a good example of a chart that you'd want to change. So most of you on this chart, you will take out the 90th percent and the 10%. The only reason you would leave the 10, you almost always will take out the 0.10%. The only reason you might leave in the 90th percentile is if your firm is the 90th percentile. If you want to show their way up there. For most of you, you're just going to show the median. So for Netflix, they built up a lot of debt. And because their earnings are growing, their debt's still growing, but their earnings are growing. Their debt to EBITDA, they used to be way out of line with the industry. Now they're back in line with the industry, but it is a positive number. You notice the industry had a negative number in 2020. Why? Probably because EBITDA went negative. So it's a nonsensical number. So guess what I'll do with that number? Go to graph chart 6. What I'm going to do, just hit the delete key. All right, you'll see how that works. And now it makes a lot more sense. So debt to negative EBITDA makes no sense. The chart is completely nonsensical. All right. But it gets really tricky because if debt is negative because it's net debt, but EBITDA is positive, you don't know which is which. So it can get really confusing. If your firm has negative numbers on charts 6 and 7, charts 5 and 6, don't show the charts. All right. Now, if your firm has positive debt, one thing you can do is then go back to debt to equity. Because they may have negative earnings. I don't think any of your firms have negative earnings year after year after year. So if your firm has negative earnings in 1 year, what do? You take that 1 year out on your debt to EBITDA. If your firm has multiple negative numbers, then you could substitute debt to equity, show it as a substitute. I don't know if I built that chart for y'all. I don't think I did. No, I didn't build it, but you could just retitle it and build it yourself. I mean, there's ways you can get it to work. Or ask me and I'll help you. All right, so the second thing we're looking at is their ability to pay the debt. This is a really famous favorite ratio for Damodaran. I don't know why he likes this ratio so much, but he uses it a lot. But times interest earned. And remember, it's times. Mark that word times. If your times interest earned is 10, I see students calling it 10%. It is not 10%. It's 10 times. All right, so be careful on that. Don't convert it to a percent. It is not a percent. So it's asking how many times greater is your earnings than your interest expense. All right, higher is better. And so the general rule I have, if you're at 2 or below, you probably have an issue. You need to watch it, especially if you're trending down below 2. If you're between 2 and 10, then you're looking at the trend. If you're between 2 and 10 and it's trending down, that's a concern. If you're between 2 and 10 and you're trending up, that's good. If you're above 10, it's probably not an issue. You just say they're good. They're really strong, right? All right. Another problem we have here is this is EBIT to net interest. What is net interest? It's interest expense minus interest income. Some of your firms have a negative number on interest. Don't show the chart if that's the case. It's nonsensical. Obviously, if they have more interest income than interest expense, they're not struggling paying their interest. It's not an issue. So on that, just leave it out. I don't know if I can show a firm that does that because I don't know any. Apple might be in that case. Microsoft is probably in that case. I think Microsoft is like that. They have more interest income than interest expense. You just don't show the ratio at all. All right. So how do you handle the paper? I'll talk about it when we do the paper. You'll just say, and looking at the ability to pay, looking at times interest earned, my firm's net interest is actually income, not expense. Therefore, obviously, they have no trouble paying, taking care of their debt. You just state it and don't show the chart. On debt to EBITDA, if they don't have any debt or their net debt is negative, you just don't show the chart and say, my firm has more cash than debt. Obviously, their debt levels are not an issue. All right, so you just get away. You kind of have a freebie on the solvency side. Obviously, firms with no debt are not having solvency issues. But again, it's the complication we have. We have accounting numbers. Firms have these numbers, throw them in there, and you got to deal with these negative numbers. And the last thing you want to do is put a chart of negative numbers when that makes absolutely no sense whatsoever. Just to show you how students get into the weeds. It's really easy to do, right? You're doing your analysis and you're just looking at numbers and you start writing without stopping and thinking. So I have students, their times interest earned goes down like the -5 because they have interest income. And they talk about how horrible their firm is because they're below 2. It's like, no, you don't want to put that on LinkedIn. People are going to be saying, where did this kid go to school? And it's not because they're not smart. It's just that they got caught in the weeds and they're writing without thinking. Always step back and say, wait, why is this number negative? That's strange. So this number, anytime you see a negative number, you should say, wow, is there something going on here? That's kind of bizarre. All right. And I've had people do return on equity when the equity is negative and write about that. It's like, it's a nonsensical number. It means nothing. 10,000 over -200 there's no sense to that number. It's just crazy. But we get in the habit of just starting writing because the example wrote about it. So always step back and ask what's going on here. All right, so that's the solvency side. So the charts I give you here, let's see if I can bring up another company here. Let's do Intuit. We'll do a technology company here. I forget what all Intuit does. It's a pretty long-term firm that's been around for a while. Bill Gates doesn't like it if I load more than 2 of these guys. All right. How's their cash from operations looking? Liquidity, that looks strong or weak? Looks pretty strong. Why did it go flat in 2023? Might be a question. How's their net working capital? Is it a source or use? Source, is it improving? Well, I'd probably say it's flat, except for something happened in 2014. We don't know if 2014, something radical happened in 15, or 2013 was like 2015 and 2014 was unusual. So we don't really know, but it's pretty flat. I'm going to come back actually on liquidity. I had one more thing to talk about on liquidity. We'll come back to when we do Walmart, you'll see it. Times interest earned. First of all, what might you do here? Might get rid of a few points, right? We'll get rid of that. What do you notice about the industry median? It looks like it's 0. Is it really 0? So let's take. Huh?
The values are big.
Yeah, so that's what we're going to do here on the debt to EBITDA. We'll go to Intuit. No, it's times interest earned, excuse me, times interest earned. And we'll get rid of these. It's a really, really high number, right? So they obviously have no issue with that. So the industry is pretty close. They're really way up there. So it's hard to tell in the industry. That's like 2 or 3. The industry looks pretty weak. But this is times interest earned. Does Intuit look strong or weak here? Extremely strong. All right. Why is that? It's probably because either they don't have much debt or they have a lot of interest income that's offsetting that. That's probably one of those two things. All right. What else can we tell? Well, let's look at their debt to EBITDA. Get rid of the point and get rid of there. So they actually do have debt. So it gets confusing. You can see that their times interest earns, man, it looks like they don't have hardly no debt. And yet here it looks like they have quite a bit of debt. Why is it? That's probably that interest expense is getting offset by interest earnings. You need to go look and see what's going on with those. Capital IQ, if you wanted to bring in the data, Capital IQ, see what I'm using on line 6? Net interest expense, you could go to Capital IQ. Instead of doing net interest expense, you could actually bring in the interest expense without netting it out. And you could look at that number. You could even redo the charts doing that. But the tradition is to use times interest earned is using the net. All right.
Would it be?
Huh?
Would it be?
Well, I can't use Capital IQs. I can't tell you here. It'd probably be pretty material because they have a lot of debt. The other issue you have, and I don't know how common this is, they kind of started doing this thing of capitalized interest, which is just ridiculous, but they would actually take interest expense, but capitalize it into the cost of a project. So a firm could have massive debt, but no interest expense because it's part of their property, plant, and equipment. So the accountants are trying to make your lives miserable. So sometimes you just have to reflect. So I'm letting you get away with this. I don't understand this. These numbers don't make sense. I need more research, but as far as I can tell, this is not a serious issue. You're going to get away with some of that. I want you at least a couple of times do bring up the annual report and try to answer the question. Try to see what's going on. That's your life. The next 50 years, so you might as well start now. I find it pretty exciting. To me, it's a mystery to be solved. Sometimes it's really frustrating. Like Walmart did something strange one time. I found it in the annual report. I read it, and they could have written it in Greek, and I wouldn't have understood it anymore. They were using these terms I had never heard before, or something bizarre going on. So I just wrote it up if Walmart did something unusual that year. It reversed the next year, so don't worry about it. But it's frustrating because these firms do really complicated things, and it's kind of like what you saw with Netflix, right? It's like this trade receivable. What in the world is that? All right, so do your best. You look at your companies and see if that's the case. The other two things we're going to do that we haven't covered yet, I'll talk about them here real quickly, and then we'll talk about them in detail when we get to Walmart next week. Let me bring Walmart up. I don't have Walmart in here. I think I got it in your class. So on the liquidity, you're going to do cash from operation growth. You're going to do net working capital requirement. And then the third thing you do is free cash flow. And how do you free cash flow is in 2 ways. And so change your formatting here. All right, so what we're going to look at here, remember free cash flow is a firm that produces free cash flow is just going to pay dividends, buy back stock, pay down debt, and do CapEx, right? So that's what I'm looking for here. This is a very confusing chart, so I'm gonna be real clear on this. The bars above and the positive are cash outflows to stockholders and bondholders. The bars below are cash inflows. Because I'm asking about, does this firm have free cash flow? So look at their dividends, you know that's the cash outflow. Very, very stable for Walmart. Look at the stock buybacks, very unstable, as you would expect. And their debt. So something happened here. That's where I say, go back and look. So that's when they bought Flipkart. Okay, so that explains it. Kendi might find something in 2018 for her firm, large debt, because they bought this, whatever firm they bought. A lot of times when you see a big issuance of debt, but y'all see, understand this. The fact this is below the line, they borrowed money. What does this green up here mean? They paid back some of that debt. They borrowed a little bit more these 2 years. So I don't know what's happening there, Bill Gates. Thanks, man. What are you doing to me? So what can we say about this firm? This must be, they must be producing free cash flow. They just sent $15 billion, or well, they borrowed some money, but about $14.5 billion out to their stockholders. They must be very liquid. They must be producing free cash flow. You don't send out that much money. Now, what if your firm has a lot of lines below and above? There are firms borrowing money to buy back their stock. That is definitely happening. That's not free cash flow. If you're producing free cash flow, you don't need to borrow money to buy your stock back. You buy your stock back without borrowing money. All right. But you see something like that, that's an acquisition. Well, acquisition is a use of free cash flow. So that one, they didn't have the free cash flow to buy Flipkart, but they bought Flipkart with debt. So, you know, it's kind of a wash when it comes to free cash flow. The other thing you might ask with Walmart is, well, maybe the reason they're sending so much cash to their stockholders and bondholders because they're just not reinvesting in the firm. They just cut back on their CapEx. But then you look at CapEx and what do you notice? Your CapEx is really strong. So Walmart looks like a firm producing tremendous free cash flow. They're buying a lot of stock back. They're paying dividends. They're paying back their debt. 2 out of the last 4 years, pretty significantly, with small issuance of debt. And they're also doing a lot of CapEx. This firm must be producing strong free cash flow, right? That's what you're looking for. Now let's look at a squirrely one, like Netflix. Sorry to use squirrely for your firm, but did that with Walmart. This is like a firm producing free cash flows. First of all, what is all of this down here? Are they borrowing money or paying down debt? Borrowing money, and they're even issuing some stock. Then 2023, suddenly a $6 billion stock buyback. And the last 3 years have all been cash outflows, paying down debt. And Netflix was a double B rated firm. It was a junk debt because they had most people didn't think about it because Netflix was so loved by the stock market. You think it must be a single A rated firm. But no, they were borrowing tremendous amounts of money and they were below investment grade. And a lot of that was related to their production and making these new shows. So it seems like that's settled down some. If I were hired, I would go in there and see what management is saying about that stock repurchase, because that's that stands out somewhat, doesn't it, on this chart? They suddenly buy at 6. Is that a one-time thing, or are they going to start paying back tremendous amounts of cash? What about their CapEx? Well, this is a strange thing about Netflix. I would have thought their CapEx was going up because of those production costs, but they're not putting those production costs in investing cash flow. They're putting it in CFO. So to me, it's just all messed up. But is Netflix producing free cash flows? Not really, because their production costs are huge. They're having to put so much into the firm. You could argue that's a sign of free cash flow. They're producing a lot of free cash flow. Okay, they can produce these new shows. That's going to produce more revenue in the future. But you know, it's a little bit of a debate on what's free cash flow, what's not free cash flow. But little score. Look at one last one. Let's look at Deere. Why not? Here, I'm going to definitely change the axis here. Excuse me. Right. So Deere is a very frustrating company because it's just all over the place. But just a quick question. Does this look like a firm producing massive free cash flows? Not at all. Looks pretty seriously the opposite. Now, can you say, well, it's because they're doing so much CapEx. What does their CapEx look like? Looks like it's actually come down. So Deere, there's a liquidity issue with Deere. We saw that when we looked at their net working capital requirement. We definitely see it here. They're borrowing a tremendous amount of money. So that makes me wonder, what are their credit ratings if you're borrowing that much money? Their credit ratings are single A. That's pretty impressive to have that kind of credit rating with that much borrowing. But Kennedy's probably going to have to talk about why this firm has so much debt. What are they using that debt for? They're not putting it in CapEx. Are they acquiring other firms? You know, why is it? So she's got a mystery to resolve and figure out for her firm. Every one of you is going to have something like that. If no one's doing Costco, what do you notice with Costco? Well, Costco, for some bizarre reason, pays a massive dividend like every 4 or 5 years. It's actually classified in CapEx as a stock buyback, not as a dividend, but they say it's a dividend. But every few years, and it looks, I mean, it is a dividend because it's going to all of their stockholders. A stock buyback cash only goes to the people they buy the stock from. But they're paying a dividend, so it is a dividend, but for some reason it's classified differently. Why did they do that? It'd be interesting to go read and see why they're doing it. So you're trying to figure out if the firm's producing free cash flows. I don't see any evidence that Deere is a very liquid free cash generating firm because you're just not seeing it. You don't borrow $11 billion if you're producing a lot of free cash flow, but they did spend $8 billion in stock buybacks. All right, so Tuesday, come in with your firm with the data. If you're having trouble, let me know. Let me help you. I would strongly recommend, once you bring the data in, make sure on the Capital IQ data page, convert all of that from formulas into values. So you can load your file here in class with that Capital IQ. All right, I'll stop it there.